Okay, so as we get started, I just wanted to kind of go over our schedule a little bit. So today we are going to wrap up chapter 10. We really don't have that much left to cover. We got through a lot of it on Tuesday. Maybe I was going really fast, I'm not sure, but we covered a lot of it. So we're going to wrap up chapter 10. We might have some time in class today to work on homework. We'll kind of see, because we don't have a whole lot left to cover in chapter 10. And then next Tuesday, don't forget to do your chapter 11 adaptive study plan, the liabilities, bonds payable. And so we'll start chapter 11 and get through as much as we can. Next Thursday, the 27th, and I'll remind you and I'll post on Canvas, I will be out of town. So we will not have class next Thursday. I'll be at a conference. So I know y'all are sad, right? I see smiles. I'm like, oh no, we don't have class. Y'all are supposed to be like, oh man, we don't have. Do it. You're excited? We have.
So excited you have a conference.
Thank you. I appreciate that. Right? Yeah. You're excited for me to learn, right? So yeah, we will not have class. I know, again, breaks your heart. So I'll be out of town Thursday through Sunday. So if you email me though, I'll be on my computer because it's like an interactive workshop or something. I don't know. But like, I don't know, but they called and said, you want to go? Sure. I'm kidding. But anyway, so it's an accounting workshop. So we'll kind of see and play it by ear after that if we need to kind of tweak the schedule a little bit, you know, since I didn't account for that in the original schedule too much. But we'll probably try to stay on schedule as best as possible, but we have a little wiggle room. If anything, we'll probably move, you know, one day back because we actually have an extra day there. We can test that Thursday, March 12th before spring break. That's my end goal, is just that we test before spring break. That way we don't come back and test. You know, I don't want to do that to you guys. But we have a day of wiggle room, so we should be good. So again, I'll remind you that next Tuesday. And then our goal will be to test either the 10th or the 12th. Again, we'll kind of play it by ear and see how we're doing in chapters 10 and 11. 11 is kind of a tougher chapter because we're dealing with bonds. So I want to make sure we hit that as much as we need to. So imagine, or anticipate, I guess I should say, your test will probably end up being Thursday, March 12th at this point, just to make sure we get everything covered. But we may have. Yeah, I think we'll probably just kind of plan on that tentatively for now, and then next week I'll make the decision. Okay. Any questions on schedule or upcoming stuff or anything? You guys pretty good? All right. So let's see here. I'm going to open back up the PowerPoint and just cover the last little bit of chapter 10. We'll do the last practice together. And then we'll go over any questions you guys might have. Okay. Whoops, I want to see where I was. We made it. So far in chapter 10, we talked about notes payable. So again, notes payable are very similar to notes receivable. We're just the ones that are now paying it. It's a liability to us. But as far as your interest calculations, thankfully, those are all the same. So you don't have to worry about new calculations. I think the main new stuff from this chapter was dealing with like payroll liabilities. So, you know, we'll go over that again before we test, of course. But just remember, you have two main journal entries when you're dealing with salaries or wages payable. We have to journalize the pay, you know, that we're actually paying them. So if you remember, we started with a debit to the gross pay, like salaries expense, and then we credited all of their deductions, and then we took gross pay minus deductions to get like a net pay, and that's what we were actually writing a check to our employees, okay? And then we had our second journal entry, which was just dealing with payroll taxes, payroll tax expense, which was dealing with, you know, Medicare, Social Security, state and federal unemployment. So that journal entry never really changes. The numbers change, but the format always stays the same. So again, we'll review those before we test over chapters 10 and 11, because those are newer concepts, right? We've only just paid employees in the past. We just said, oh, we paid them cash. So it's a little bit different. And then again, the rest of this chapter, we're still staying in current liabilities. So let me find exactly where we were. I didn't make a note of which PowerPoint slide I ended on, but I can find it. We finished all the payroll. There's a lot of slides in here that talk about all of the different contributions that employees can, have withheld from their paycheck. I encourage you to read over that in the PowerPoints or in the chapter. We're not going to go into major detail on those, just because you learn a lot of that in your personal finance class if you've taken it. I know you have to take it eventually, so you're going to go over a lot of that. So we're not going to be repetitive in here. I want you to understand the journal entries and just understand employees can make a lot of different types of contributions. And we talked about that. They can have voluntary. There's like sometimes required taxes on employees are like the FICA, Social Security, and Medicare, federal income tax. And then states that have income tax, which we do in Oklahoma, we have to withhold that as well. And then there's a lot of voluntary. So voluntary could be like health insurance, 401k or 403b pension, charitable donations. You can even have where, and I've done this in the past because it just made it more simple for me, where you have your employer take out some for savings. So they transfer $100 a month or $200 a month to a different account for you. That's an option too. That way you don't have to set it up and you don't ever see that money. It's a good idea, right? Cafeteria plans, which if you've never heard of cafeteria plans, again, you'll cover those in personal finance, but cafeteria plans are like pre-tax money that you can have taken out of your check to cover healthcare, out-of-pocket healthcare, or like childcare. When my daughter was in daycare, I had it taken out because that way I'm not taxed. They take your gross pay minus that cafeteria plan contribution, and then they calculate taxes on it. So it's kind of a nice little, it's the same as at the end of the year when you are doing your taxes, you can take credits against that stuff, but you're actually on some of that, like you have to have so many healthcare costs to be able to itemize if you do your own taxes, or you will eventually. So having that come out pre-tax of your paycheck saves you a lot of money that you won't get at tax time. So like I take out like $800 a year and pre-tax to pay for out-of-pocket, like going to the doctor and paying for my son's classes and my daughter's dental, or all of that stuff. It covers me and all my dependents, whether I'm covering them on a healthcare plan or not. So just some basic information. There's some great information out there when you get a job, or if you already have a job, looking at those benefits. So those are some voluntary deductions. So again, I'm not going to go into more detail on that. There's so much in this chapter on that. And again, like a lot of that's more personal finance type stuff. I just want you to understand there's lots of deductions that an employee can voluntarily have withheld. Okay. Any questions on any of those? If you ever have questions, I've taught personal finance, so you can always come to me, outside of class too, if you do have questions. So it's kind of fun stuff to talk about, right? Maybe. I enjoy it, but you guys might, whatever. Bless you. So the last little bit of this chapter, we're going to talk about installment notes, and we'll do an example on that. And then the last thing we talk about is contingent liabilities, which you won't actually have any exercises on, but you just need to understand what a contingent liability is. So installment notes, again, we kind of talked very briefly on Tuesday. An installment note, again, is more like when you have a note on like a mortgage, or even for like a vehicle or something like that. So installment notes are different because you're making more than one payment. When we have a note, it's usually 90 days, we pay the principal plus interest, and we're done. With an installment note, it's like if you have a vehicle loan, right? If you have a vehicle loan, you're paying it usually monthly. Or even if you just take out a short loan from the bank to help build your credit and you're paying it back monthly, that is an installment note. So it accumulates interest differently, because every time you're making the same monthly payment, right? Well, every time we make a monthly payment towards, say, my vehicle, a different amount of that is going to principal and interest. And that's because it's calculated based on your outstanding balance. So every month, they're calculating interest on what you owe at that point, which is going down over time, okay? So as you make payments, some of that hopefully is going towards your principal and your balance is going down. So your monthly payment is static, it stays the same. You make the same monthly payment month after month, year after year. But how much your principal is due, how much you owe is going down. And so your interest every month is going down, okay? So we're going to look at that and look at how to account for it. The cool thing is I'm going to show you after we do the practice, if you like Excel, you can get like templates to calculate installment plans on Excel. Like you click a button, you type in the principal, the interest rate, and all of that, and it calculates all of it for you. It's really cool. I'm going to teach you how to do the math by yourself, but Excel will do all the math for you. And, you know, again, I'm the Excel nerd, so I run these schedules for myself at home, like on my car payment. And then I'm like, well, what if I put like an extra $50 a month towards my car payment? You know, how much am I saving over time in interest? Or, you know, how more quickly can I pay off this car if I put a little extra towards it or double up payments? So it's kind of a cool tool. Again, it's kind of personal finance linked too, because you can do this at home on any type of loan you take off or take out. And if it's a higher interest rate, you know, the sooner you can pay it off, the more money you're going to save. Okay, so we'll kind of look at that and play with that, because if it's over like a 4 or 5% interest rate, then you're gonna, you know, the more money you put towards it, the more money you will save, because that interest will really rack up, especially depending on how much you originally borrowed. Okay, so it's kind of fun. We'll play with that just a little bit. So again, installment notes, we're making equal periodic payments to the lender over the life of this note. Okay. And it can be a yearly payment or it could be a monthly payment. And again, out of that, we have the principal balance and then we have interest. So every time we make a payment, some portion is going to principal and some is going to interest. Okay. When we pay off the note in full, we have paid all the principal back and all the interest. So again, installment notes are used more for like long-term asset acquirement. So we're looking at, we'll take an installment note out if we're buying land or buildings or, you know, equipment or even a vehicle or something like that. Something that we can't afford to pay cash this year, okay? And that doesn't mean we have to. You know, we have situations where obviously if we have a good net income, if we have a good profit, we may have the cash to pay, you know, for some of these out of pocket. But we're looking at if it's several $100,000 worth, you know, we'd probably do it on an installment note, okay? So basically, and you probably know this, again, it works just like if you take out a car loan, whoever you're financing this note through, like say the bank will own your property, you know, while you're paying towards it. So if we stop payments for several months or years or whatnot, they can seize the property, you know, so it's really like what we call a secured note, because you have something the bank can come and take from you, okay? Or whomever owns the note. So when we first issue an installment note, it really is pretty similar to taking out just a regular note. So when an installment note is issued for cash, for instance, we're going to debit cash and credit notes payable. Okay. And again, an installment note may not be for cash, it may be to purchase some long-term equipment or a long-term asset as well. But
so you just debit that, like debit car?
Yeah, you would just debit car or land or whatnot, and then you'd put that in the notes payable. Very good. And sometimes we might even pay some cash down, right? Like if you go buy a car, you may put $1,000 down and then finance the rest. So if we did that, it would look pretty much the same. You would have like a debit to your asset car and then a credit to cash for like $1,000, and then a credit to notes payable for whatever you're financing.
Minus the amount of cash you paid.
Yeah, you would take your car, say it was a $20,000 car, 20,000 minus that 1,000, you're financing 19.
So
yeah.
the note would be 19.
Yeah, very good. And that's pretty common, right? A lot of times we do put some cash down to reduce our liability. So to illustrate, assume that on January 1 of year 1, Lewis Company issues the following installment note to City National Bank. So in this case, we are actually borrowing cash. The principal is $24,000. It has an annual interest rate of 6%. The term of the note is 5 years. And in this case, we're just making an annual payment. So every year, we're going to pay them $5,698. That payment is calculated by the bank. Again, I'll show you there's a payment function in Excel that you can calculate at any amount that you're financing at any interest rate and any term. You can put it in and it'll calculate your payment for you. It's pretty cool, okay? So when we issue the note, it's just like issuing a short-term notes payable. We debit cash for the $24,000 cash received, and we credit notes payable for that liability that we're taking out, okay? The difference is how we make payments, okay? So the journal entries change as we make payments on this installment note. So again, we're making equal payments every year on December 31st for 5 years. So every time we make an installment payment, it's the same credit to cash. We're paying $5,698 of cash. How much goes to our principal and how much gets charged to interest expense will change with every payment. Because every year we have a new principal balance, right? Because we paid some of it off. So our interest will go down over time. Our interest payment will go down, not the rate. The rate stays the same, okay? So we're going to look at that. And this is what we call like an allocation of periodic payments, or, you know, we're looking at the whole payment schedule for this note. So when you take out a loan, they usually give you this schedule, okay? So I'm looking at a schedule here, and they show you over time what your payment is doing. So in year 1, the carrying amount, or the amount that we owe, is $24,000. Well, we paid on a note payment, we paid $56.98 cash. So $56.98 cash gets credited because we paid it out the door. Notice it tells us what the interest expense is. So since this is an annual payment, we're only making a payment once this year. We can take that full $24,000 times the 6% annual interest rate. Okay, we charge 6% for the whole year, and it's only a one-time-a-year payment, which is a little different, right? So we truly take $24,000 times 6%. Of that payment we're making, $1,440 of it is interest expense. The $1,440 gets debited to interest expense. And then the decrease to notes payable, we take our total payment minus the interest, and our decrease to notes payable is a debit of $42.58. That's how much we're paying towards that principal balance. So the decrease in notes payable is a payment towards the principal, towards the carrying amount. So then at the end of the year, we would take our $24,000 that we owed minus that decrease in notes payable, and now we owe $19,742. So again, just to kind of visualize that in a different manner, you could keep track of your notes payable. Okay, so what's happening over time? Notes payable is a liability. It increases on the credit side. Okay, so when we initially took that loan out, we'll just say on January 1, it was $24,000 credit. When we made a payment on December 31st, we decreased, or we debited notes payable $42.58. And this is year 1, okay? So every year that we make a payment, what we owe is going down. Okay, so you can always balance it after the end of that year, just like they did. And now it's $19,742 balance, the beginning of year 2. Okay. And then they do the same thing. Our credit to cash is always the $56.98, but now we calculate interest on our new balance. This is how much we owe now. So we take 6% of that. And our interest is $11.85. That gets debited to interest expense. And then we take our payment minus interest, gives us the reduction in principal. it's going, our interest is going down because interest is calculated on what we currently owe. So interest is going down and what's going towards principal is going up every time we make a payment. So we just continue on, every year. Now our balance is 15,229. And then in year 3, we made an interest payment of 914. I'm sorry, that's the interest. Our principal went down 47.84. So we just kind of keep going. So after we make that payment, our balance is 10,445. And then in year 4, we made a reduction of $5,071. And then at the very end, we owe $53.74, which notice that's our last payment. In year 5, we pay $53.74, which zeroes that account out. And these are all beginning of the year. Okay. So as we debit and make this payment every year, we're reducing the balance in our notes payable. We're reducing what we owe. So every year, we're going off of a new principal amount to calculate interest. It's 6%, but it's just changing. Okay. So this is our schedule showing how that's changing. Any questions on that? Okay. So when we make a payment every year, again, every year we're crediting cash the same amount, the $56.98. In year 1, $14.40 of that went to interest expense, and notes payable was debited to $42.58. Okay. So every year we debit interest expense and debit notes payable, and they should add up to the total payment, that cash payment. Because remember, we took the cash minus interest to get to that face value reduction. Okay, so we make that entry every year. Cash is the same credit, but our interest expense and notes payable change every year. So the next year, again, cash is credited, but interest expense is a little lower at $11.85, and our reduction in our notes payable is a little higher at $45.13. And again, we just do that in year 4, year 5, until it's all paid off. Okay. So when we have made 5 payments, our notes payable should be 0. Now, because we're rounding to the whole dollar here, and even if we rounded to 2 decimals, there's times at the very end where your last payment might be like $1 more or $1 less, just to account for those rounding, but it's still pretty similar. Okay. Okay, well, let's go ahead and finish the PowerPoint. Then we'll do the last practice on installment notes just to round it out. So the last part of the PowerPoint, again, just talks about what we call contingent liabilities. Again, it's just important for you to understand what a contingent liability is. You don't really need to understand much more than what it is and how we report it. Okay? So a contingent liability is a potential liability. So the biggest one I can think of is like a pending lawsuit. That happens a lot with companies, right? So if we have some pending, adding words together, pending lawsuit, we know that can impact us in the next year. If we have a pending lawsuit, there's a possibility that we might have to pay out money next year, which is a liability. So it depends on how certain that pending lawsuit is on how it's reported. Okay? So we look at 2 things. We look at the likelihood. Is it probable, reasonably possible, or remote? Okay, so we have to think about it. Okay, this lawsuit, maybe just someone sued us for some really random reason, and our lawyers are like, yeah, it's in pending litigation, but we think the case is going to get dismissed. That would be like a remote possibility. if it's one of those that's kind of on the bubble, like I'm sure McDonald's was when they got sued for, someone spilling hot coffee on themselves, that's reasonably probable. Like you think, oh, it could go either way. We're not really sure. It's in the beginning stages, a lot of times in a lawsuit. So that's reasonably possible. If we're at a stage where we are already, negotiating and trying to settle the case, then it would be probable. And then we also have to look at, can we measure it? Because if it's in the beginning stages, even if it's probable or reasonably possible, but we have no idea the monetary impact of it, how are we going to report it? We know we need to report money on our financial statements. So this is all about financial statement, annual reports, things like that. So if we're able to estimate our potential liability, then we will, and we'll disclose that. If we're not able to, but it's pretty probable that it's happening, we'll still disclose it because we want to be transparent, okay? So if the liability, contingent liability is probable and we can estimate it, we report it and disclose it. So we actually go ahead and make a reporting for, this is coming in the future. The liability is reported by debiting some expense, depending on what the liability is, and we credit a liability. So we will record it as an upcoming liability if it's both probable and we can measure it. One such example would be like a warranty. If we sell cars, a lot of times, there's some warranty associated with that car. Or if we even just sell anything that any type of equipment, like a washer, for example, usually comes with a 1-year warranty, right? Manufacturer warranty. If we're the manufacturer, that warranty that we're giving to our customers could be an expense to us, okay? In my experience, they usually start breaking after a year, right? When the, when the warranty is no longer, that's what my dryer did, it was like 15 months, but anyway. So assume a company sold a product for $60,000 and it included a 36-month warranty for repairs. That's a pretty good warranty. The average cost of repairs over the warranty period is 5% of the sales price. So this is an estimate, and we're able to estimate it. So what we're saying is if we sell products that we offer a warranty on, that is a probable contingent liability, and we are able to measure it because we can go back and look at previous years and kind of average how much we've spent in these warranty repairs. So that's kind of, again, that's only for companies that sell products with warranties though. So that doesn't apply to every company, right? Even if you're like a reseller, like a retail, you're probably not the one with the warranties. I know if you go to Walmart and purchase electronics or something, you can purchase their warranty that, is different than the manufacturer one, like an extended warranty. So in that case, this would apply to them. So they just take $60,000 times the 5% average sales repair, and they get $3,000. So our product warranty expense account is debited, and then we have a product warranty payable credit. So that's just anticipating in the next year or 3 years, really, what our warranty expense could be by offering this warranty. So that's a probable liability or probable contingent liability. Then if they did bring in that equipment for repairs, we would debit the product warranty payable for however much we spent in repairs and credit cash, or if it was labor, like wages payable, or it could be like parts if we had like a warranty repair center and we had parts. So it just depends on how the repair was made. If it was just all labor, we could credit wages payable. Okay, so it depends on the situation. So these are, as you can imagine, adjusting entries we would do to debit that product warranty expense and the product warranty payable credit. Good old adjusting entries, right? So then we're the next year, and we assume that a $200 part is replaced under warranty on August 16th. We will debit, again, that product warranty payable because we are meeting that liability, or $200 worth, and we credit, in this case, supplies because we had the parts on plate, in inventory. Okay. So again, it's just kind of, those are contingent liabilities that are probable and we're able to measure it. If we think it's probable, but we can't really estimate it or measure it, we just need to disclose it in our financial statements. Again, it's just part of our GAAP compliancy that we be transparent and report anything that's possible. Okay. If it's reasonably possible, we would also disclose it in our financial statements. So anything that's probable or reasonably possible, we just put it in our notes of our financial statements and hope, you know, that no one reads it. And if it was just remote, if it was a remote possibility, we do not have to disclose that. Okay. So if there's a remote possibility of some pending lawsuit or some pending contingent liability, we don't have to disclose it. So only disclosing, if it's measurable, we report it and journalize it. If it's probable or reasonably possible, but not measurable, then we just disclose it in the notes of the financial statements. So those are kind of things as we move through the semester, towards the end of the semester, and we look at doing our financial group project, which we'll talk about probably in a week or two. That will just help you understand what's going on in your financial statements and in those annual reports. Okay, so they give you a nice flow chart of what you need to do, and we talked about that. So that's just a nice little review so you kind of understand how to handle them. Again, it won't, I don't think it, I'll have to look back over. I don't think it's on the test at all, but it's just, again, important to understand how it's handled. You may have a multiple choice on how a contingent liability is handled. Liabilities all get reported on the balance sheet. Again, current liabilities are put in first. We have accounts payable, notes payable. Notice it says current portion. So again, if we have one of those installment notes, we would list the current portion, the payments due this year, up here in current liabilities, and anything beyond this year would be listed as a long-term notes payable. We have salaries and wages payable, payroll taxes payable, interest payable. All of those are just current liabilities that are reported on the balance sheet, and then we would see total current liabilities. And the next chapter we'll get into long-term liabilities. So we're just separating them out and listing them all there. Okay. Yep. It's a nice abrupt ending, right? And then we're done with the chapter. Any questions on anything so far? Okay, well, go back in. If you're not logged into Canvas, go ahead and log into Canvas and go back into your Chapter 10 practice. Chapter 10 practice, and I think we just have one left. We're going to look at an installment note, and then I'll show you kind of how to set that same thing up in Excel. Just, you know, if you're interested in that. It can help you on your homework. It'll do all the math for you, which is never a bad thing, right? I'll let you do that. You do the Excel file. Let's see, we're on the very last one. Okay. So in this case, they're showing us an amortization schedule, which is, again, just showing us a schedule of how we're paying off this note over time. So on January 1 of year one, Bryson Company obtained a $147,750 4-year, 7% installment note from Campbell Bank. The note requires annual payments of $43,620 beginning on December 31st of year one. They want us to fill out the schedule and show every year how much of that is going to the principal and how much we're paying in interest. Okay, so that's what we're going to do. In year 4, it says due to rounding, the year 4 interest expense is provided. Again, we're rounding to whole dollars here, so when we get to the end of the loan, we don't want to pay more than what we owe, right? More than the principal balance. So they've adjusted for that for us. So when we're filling out this amortization schedule, well, they told us what our payment is, $43,620. So in that second column, the note payment, the cash paid, is always $43,620. So we're making the same payment every year for 4 years. I can just fill that in for all 4 years. So we're making that same cash payment. And then to get the total, obviously, I would just take that 43,620 times 4 to get how much I'm paying total on this note, which should be 174,480. 174,480. So 43,620 times 4, 174,480. And again, just to compare, I originally borrowed $147,750. So you can see we're going to pay total interest of over like $25,000 over the life of this note. Okay. So let's look at carrying this through. So in year one, our carrying amount is just the full amount we borrowed. So year one carrying amount should be the $147,750. $147,750. Okay. Well, this is an annual one, we just make a payment once a year. So how would I calculate interest for year one?
Multiply the carrying amount by 7%.
Yeah, exactly. Very good. I'm going to take my full carrying amount times 7%.
$33,277.
Perfect. $33,277. Okay. So 147,750 times 7%. As you're doing these on your homework, I think you have one that's like a monthly payment.
Oh, I'm sorry. I was reading wrong thing. It's 10,343.
I think you're right.
The interest is.
Oh, you gave me the decrease in notes payable. Yeah, see, I just looked, I'm like, that number's on my sheet. Yeah, thank you. Thank you. What'd you say the interest was?
10,343.
Thank you. Yeah, so 147,750 times 7%, 10,343 in interest. Thank you for correcting that. So on this one, since we're just paying it once a year, we can use that annual interest rate of 7%. If we were making monthly payments, if this was split up into making a monthly payment, you would want to take your 7% and divide it by 12 to get a monthly interest rate. Okay. The 7% is the annual interest rate, how much we're charging them for the whole year. So if you're doing a monthly schedule, and I think you might on your homework, pretty sure, take that annual interest rate of 7% and divide it by 12, because you just want 1 month's worth of interest if we're making monthly payments. You don't want to charge them the whole year. They won't be happy. Or in this case, I guess we're getting charged, we're the company. We don't want to pay a whole year's worth of interest. That'll throw off your calculations. Okay, but in this case, it's just a once a year payment. Then I have to scroll down to scroll over here. Our decrease in notes payable is the 33,277. So we take our payment amount, the total we pay of 43,620 minus the interest. So our decrease in notes payable is the cash paid minus the interest. That's 33,277. 33,277. The last thing we want to do is get our carrying amount for the end of the year. In that case, you want to take your original carrying amount of 147,750 minus this decrease in notes payable. Okay. So again, in this case, we initially had a credit of 147,750. That's the beginning year one. And now we've debited it 33,277. And this is year one, December 31st. Okay. So I'm just going to take my 147,750 minus that 33,277. So how much do I now owe, or what's my carrying amount?
114,473.
Very good, 114,473. Okay. Any questions on that? Can we just do the same thing the next 3 years? So our ending carrying amount for year one becomes our beginning year two. So we just carry that down, the 114,473. 114,473. And then what do I do next? Very good. I take 7% of that. So I'm going to take 114,473 times 7%. And my interest in year 2, very good, 8,013. Okay. And how much did I pay towards my principal with that payment? 35,607. Very good.
So basically your interest will go down as your principal goes up.
Yes. Yeah, you'll always see that. Your interest paid will go down slowly and your principal payments will go up. And that's because you're calculating interest on what you owe currently.
Gotcha.
So every year what you owe is going down. So your interest will go down. Yeah, you got it. So we have 35,607, decrease in notes payable. So our carrying amount, we'll take the 114,473 minus 35,607. Perfect. 78,866. 78,866. And then we go to year 3. We just carry that balance down. The 78,866 is our new carrying amount. 78,866 is our new carrying amount. So what's my interest expense for year 3?
5,521.
Good. 5,521. 5,521. What's my decrease to notes payable?
099.
Perfect.
$38,900.
$38,099. Good. 38,099. And then I take my carrying 78,866 minus the 38,099. And we should get 40,767. Sorry, 40,767. And we're on our last year. We pull that carrying value down, 40,767. Well, again, due to rounding, notice they gave us our interest expense. And really at this point, we're in the last year of the loan, so our carrying amount should also be our decrease to notes payable. You could still take your cash payment minus the interest. You should get the same. And we should be paying off the carrying amount of 40,767. 40,767. And at that point, our carrying amount becomes 0 because we've paid all 4 payments. So then I just need to do my totals. Well, we've already added up our total cash paid. We would add up our total interest expense. So we'd add all 4 of those. You should get 26,730. 26,730. And then we would add up our total decrease in notes payable. So we'd add up all 4 of those. And you should get 147,750, meaning we've paid off the full principal. Okay, so when we add up all of our decreases in notes payable, it should equal the original carrying amount. Okay. So over the life of this 4-year loan, we paid $26,730 in interest. A lot, right? Okay. So once we do that, once we've set up the amortization schedule, we just need to journalize and put in the issuance of the note and then all the payments we made. Well, we have all the numbers up above. We just have to plug them in. So when we first issue the note, we debit cash and credit notes payable for the 147,750. 147,750. When we made our first payment in year 1, we know we paid $43,620 in cash. So cash is going to get credited. And then we also want to recognize these 2 things. We want to recognize our interest of $10,343 as a debit to interest expense. And our decrease in notes payable, so a debit of $33,277 to notes payable. So we've done all the math, we just have to journalize. So again, we are going to debit interest expense, $10,343, and debit notes payable, $33,277. And our cash credit is our payment amount of $43,620. Okay, so that's our journal entry at the end of year one. And then we just have the next one, year two. Again, cash is always a credit of $43,620. You can kind of fill that in all the way down. You know, cash credit, $43,620. That doesn't change. We just need to change what's charged to interest and the reduction in principal. So year two, interest expense was a debit of $8,013. $8,013. Notes payable went down $35,607. $35,607. We would do the same thing for year three. Interest expense in this case for year three was $55,21. $55,21. And reduction in notes payable was $38,099. $38,099. And then year four, we had interest expense of $2,853, $2,853. And notes payable went down, the remaining carrying balance, $40,767. $40,767. So on part C, it says, how will the annual notes payment be reported in the year one income statement? So what goes on our income statement? What two types of accounts? Revenue, very good. We have revenues and expenses. Well, of that first payment, did we have any revenues? No, we made a payment. Did we have any expenses? Interest expense. So with this loan, our annual note payment on the, as far as the income statement is concerned, we're reporting that interest expense. So that's all it's asking us. Interest expense in that first year was $10,343. So in year one, our net income would be reduced by that interest expense of $10,343. That's just kind of showing you the impact on the financials. Again, though, on the flip side of that, you know, we receive cash, so hopefully we're using that cash to infuse in our business and earn profit. So there should be some balance there. Any questions on that? Okay, so I wanted to show you just really quickly the fun stuff in Excel. So you can submit that or save it. And then you can do this with me or you can just watch. I'm just going to open up Excel. Okay, so I'm just opening up Excel into a new blank worksheet here. If I click on File and then go to New, File and New, I can search, I'm just going to search for loan. So I just typed loan on File, New, Loan. And mine popped up right here. I have a loan amortization schedule. Okay, loan amortization schedule. These are called templates in Excel. Word and Excel both have them, and even PowerPoint too, where you can download templates that other, like Microsoft has created that already have like formatting and formulas, so you don't have to do all the work. It's great. So I'm going to click on Loan Amortization Schedule and click Create. And this one was created by Microsoft. And it looks nice, right? It's pretty. It's always nice. So what this is a template in Excel that's already been created where we can enter in our loan information and it will create that schedule that we just did in the example together, but we had to do all the math, it'll create it all for us. Anything that does the math for us is always nice, right? So I'm just going to go off of kind of what we had on that last example. I had a loan amount of $147,750. We had an annual interest rate of 7%. 7%. My loan period in years was 4 years. 4 years. And I'm just making one payment a year. One payment a year. And I'm going to zero out that optional extra payments. I'm going to zero that out. Okay. And they're rounding to 2 decimals, so ours look a little bit different than our schedule, but here, just to kind of show you, I'm going to take off the zeros. This looks just like what we completed in our problem. It's pretty cool, right? It's a lot faster. So we took on, this is, I didn't put in the correct dates, but it doesn't matter. So this loan, if we took it out today, we had a beginning balance of $147,750. Our payment was $43,620. Well, that was what the problem told us our payment was. We had no extra payment. Our principal was $33,277. Our interest was $10,343. That was the exact same stuff we just calculated in the problem. So you have these great resources that accountants use because why not, right? We don't have to, human error, right? We could make errors in our calculations and get the wrong amounts. So I didn't have to create this. You can create your own, but why? It's already created for me. You can plug in anything here. So again, if we were making monthly payments instead of yearly payments, on this one, I would just change my number of payments per year from 1 to 12. Okay, it went back to my rounding to 2 decimals, but still, you get a new payment schedule. So you see every payment made, all the interest, all of that. Okay, so it's kind of cool. And then if you look at, you can actually click in the cell and notice they have like this big long if statement. You don't have to know how to do that though, because you just used an existing template. Okay. But ultimately, to kind of read it, what they're doing to calculating interest is they're taking the beginning balance times the interest rate divided by the number of payments per year. Yes, sir.
In the homework that has this decimal point and has this round,
Uh-huh.
how would you do that in the Excel sheet?
Oh, in the Excel sheet, if you want to round, there's a couple ways to do it. The easiest way is just select whatever you want to round. Let me make this a little bigger. So I can just click and drag like anything I want to round. And then up in this alignment box, or sorry, number, up in the number box, there's a little one that says 0.00 and then it has an arrow to 0.0. If you click that, it'll take off your decimals. It'll round it. Why is it not doing it to those? I guess because I already took it off of some. But yeah, you can select whatever you want to round to 0 decimals. And up in that number box, just click it twice to take off the decimals. So yeah, then you get the rounding. So you don't have to mess with rounding it too. Okay. So again, the cool thing about this too is I can play with this if you want to use it for personal use and look at your loan payment for whatever loan you might have. Pop in your values, and then I could put in, well, what would happen if I paid, in this case, since it's a big loan, what's our scheduled payment? What happens if I paid $500 extra each payment? Well, right now it tells me over in the loan summary how much my total interest is. I'm going to pay $22,000 roughly in interest over the life of this loan. Well, if I made $500 extra payment every time I made this payment, I've just reduced my interest by almost $3,000. Okay. So you can kind of play with it and see, well, if I have my own loan and I'm making these monthly payments, if I can afford to, make a little extra payment here and there, how's that affecting how much interest I'm paying? And I went from 48 payments to 42 payments. So So I've paid this loan off 6 months earlier and I've saved myself $3 grand. So it's kind of cool. Again, you can use it for homework and calculating these amortization schedules, but you could also plug in your own loan information and figure out, you know, how things are going. This is a big loan, right? $147,000. It's more like a mortgage. But again, it's just a great tool. It's already created for you in Excel. When you're doing your homework, just remember again, if it's a monthly payment, if you're not using this, take your annual interest rate and divide it by 12, okay, to get a monthly interest rate. It's doing it for us in here because I put in 12 payments a year. But yeah, it's calculating the scheduled payment and everything. So it does all the math for you. Any questions on that? So feel free to use that, you know, at home if you have Excel, or here at the school, you should be able to go in, file new, into the template, search for loan or loan amortization. And we can do the same with bonds next chapter. It'll just be a good tool to use. Okay.